Hey y'all, it's Carolyn Bauerschlag of the Bauerschlag Group at Keller Williams. Actually at home. I'm in my dining room right now, as I suspect a lot of us will be for the next couple of weeks. I wanted to touch in with my database here. The news in the marketplace has been chaotic, and there's been a lot of bad information floating around. And so I felt compelled to come in and do a little bit of myth busting to bring this back to a bigger picture and to hopefully have a more facts-based conversation instead of a fear-based one. And wanted to offer a little bit of perspective too. So I'm going to just quickly roll through what the big picture appears to be, the monetary policy that the Fed is currently engaging in, what we can expect, at least in the short term in our marketplace, and to bring this back to a couple of examples, both with oil busting back in 2015, 2016, and what the crash 2008 looked like, and how that's different actually from today. So just big picture, we are looking at the end of what was one of the longest bull markets in modern financial history. So we had an incredible run on the market, and since 2016, we've actually seen almost 100% increase in the Dow Jones Industrial Average and the S&P 500. And if you listen to traditional investing wisdom, what they'll tell you is that an 8 to 10% gain in any given year is actually really great. And so for us to look at, on average, 100% in 3 years, or call it 25 to 30-ish% a year, that's unsustainable. And coronavirus appears to be the catalyst, not the cause for this correction, but the catalyst for the correction. When you look at traditional economic cycles, historically they've lasted about a decade. So between expansion, recession, peak, valley, usually takes about a decade to move through that. And 2008 represented the start of a bust. 2009-ish represented that bottom. And so we've been kind of on the way back up ever since. So from a timing perspective alone, we were due. So Corona seems to be the catalyst for the change agent here in this conversation. What that's done is it's sent the markets into a tailspin. From the appearances of it, and I want to gently remind everybody to not listen to the total point loss and to the headlines that are sensational that say things like biggest losses posted ever. That's definitely true. Today we saw a really bad loss as well, but I want to focus the conversation back on a percentage of the whole when we're talking about movement and not necessarily the points. Back in 2008, we saw a 700-point slide, and that was the single day largest slide at the time. So it's all a matter of perspective. Now, we definitely are, by all intents and purposes, or for measurement's sake, we are in a bear market, or we're entering into a bear market, and that's going to change things. It'll change human behavior, but I want to bring this back to a message of optimism and being able to still move about in our daily lives. I also want to cover the misinformation that's floating around right now about interest rates. I've seen this from peers. I've seen this from other realtors across different cities. The Fed cutting the benchmark rate down to zero has to do with short-term lending between financial institutions. The purpose of it is to grease the wheels, to keep capital flowing between banks. It is not the 30-year mortgage rate. Okay, so if you see anybody posting anything that says, hey, great news, it's a great time to buy because interest rates for you are going to be really low, that person is misinformed, and please give me a call so that we can chat about this and get you some better information. The reality is that when the Fed benchmark influences what happens for all interest rates, but it is not 100% correlated to the 30-year note. What you may be more familiar with hearing is that the 10-year treasury curve and the 30-year mortgage tend to move in lockstep or in tandem. Even then, they're still not 100% correlated. So for the Fed to drop rates to zero in and of itself is not a positive market signal. What they're saying is that we are going to try to make moving money as easy as possible without as much cost as possible. What that means is that there's no other monetary lever for them to pull without starting to dump in cash into the economy. In fact, quantitative easing round one was announced, I believe, yesterday. There's going to be $700 billion of money issued into the economy, and it's probably going to be done through bond purchases from the federal government. So quantitative easing, we saw the last time post 2008, and it came in 3 tranches over the course of about 3 years. So they injected trillions of dollars into the economy at the time. So that's coming. So a lot of that feels like 2008. Now, with respect to real estate interest rates, when rates dropped about 10 days, 2 weeks ago, they fell almost all the way down to 3%. What we saw in the last 10 days to 14 days was a dogpile onto those credit lines. And so if you are financing a home right now, if you're going through that mortgage process, you're probably seeing things slow down a little bit because the appraisers are overworked, the processes are overworked, the underwriters are overworked. So there's kind of a slowdown going on right now. So then what happened is that interest rates went back up. So these credit lines and these warehouse lines and these creditors basically hedged and said, we need to get the strain off the system. So we saw interest rates, in fact, bounce pretty heavily last week. So right now they're right around 4.5, 4.25. And to bring that into a different perspective again, 4.25 is almost not different at all than where we were 3 months ago. So we ended the year right around 4% with good credit. And prior to that in the fall, 4.25 was still pretty great. Back in 2018, we saw 4.5. And really, we haven't seen much above 4.5 since 2008. If you go back and you look at 30-year mortgage charts, the last time that they were really that high was back in the pre-crash era. So at that time, they were about 6%, and that might have been with points paid or basically fees paid to get the interest rate down. So perspective is really important here. The cost of borrowing is still historically low, and I can't understate that. So if you see anybody posting videos saying that the rate of interest that you can get on a mortgage is 0%, that's wrong. If you see anybody posting that rates are at an all-time low, that's not technically accurate, but rates still are pretty good right now. So don't panic with respect to your real estate investments right now, okay? The other thing that I want to point out just briefly is that the people that I've been consulting with and the people that I love and trust have more or less stated that they expect that once coronavirus exits the market, once we see a return to business and normalcy, once the credit lines and the warehouse lines are opened up and we don't have the strain on the system that's going on right now, we should see interest rates level out and in fact probably trend in a downward direction again. So with respect to real estate, again, don't panic right now. I feel like it's helpful if we bring up a couple of examples for comparison's sake. Houston and Texas, and I guess some of the more tangentially related states that have oil-heavy businesses saw a micro recession, if you will, back in 2015 and 2016. Like I mentioned from the get-go, I graduated right into the economic crash, 2008. And the news since then has been about once every 2 years that something was causing the economic sky to fall or the economy to bottom out, and we haven't died yet. So back in 2016 as when we saw probably the bottom of the real estate market in Houston for the effects from the oil bust in November of 2014. I'd gotten my license just a few months prior and was pretty excited about rocking and rolling through real estate. And then for the second major time in my young adult life, they said, hey, the sky's falling and you won't be able to sell houses and things will be terrible. And the reality is that wasn't true. It wasn't true. Okay, so broadly, if you've worked with me before, you've heard me say that my one true wish in this world for anyone who buys a home is that you can stay in it for at least 5 to 7 years. And many people ask why. And the underlying reason is because your typical economic cycle, like we stated previously, is about a decade long. Real estate is a wonderful investment in the long term, and it's highly brittle in the short term. Meaning if you bought in 2013 and then you had to sell it 3 years later, in Houston, that meant that you bought at an absolute high and that you probably had to sell at an absolute low. So when you hear these sensationalist stories that go around saying, oh my gosh, I lost 10 to 15% on real estate, it's a terrible investment, it may have in fact just been unfortunate timing. So when we're talking about what's going to happen next, my one true wish for anyone who chooses to continue to transact is to say, instead of maybe us looking at a 5 to 7 year horizon, maybe what we're talking about now is a 7 to 10 year decision. if you were going to still do something in 2020, if you had a life circumstance, you got a new job, still sell. If you wanted to move across the country because you're retiring, still retire. If you wanted to buy a different house because you are having a baby or a life event and you're adding family members to your actual residence, those are all still really valid and wonderful reasons to continue to invest and purchase real estate, right? So on average, the National Association of Realtors tells us that each year real estate improves by about 3 to 5% each year, and that's on average. So that's your long haul. There's peaks and valleys, absolutely, just like the stock market, but in general, real estate is a stable investment. I don't want you getting caught up in a knee-jerk reaction or a panic button situation where you try to just pull the plug and say, I'm not going to do this anymore, and you make a short-term decision that really would have an unfortunate impact to your bottom line. So interest rates, again, are in good shape. You are going to have to pay to borrow money. The market right now is still moving. I was in an open house on Sunday. We had 5 sets through, and that particular house is going to be in a multiple offer situation. Things are still rocking and rolling. People still need to buy their homes. One of the interesting things that we saw in oil in 2015 and 2016 is that the average price of homes came down, but the median value of homes went up. And what that tells me is that in Houston, Texas especially, real estate is stable. So maybe people were trying to offload their more luxurious properties and try to reduce their overall carrying costs, but they were turning around and potentially buying something that had a lower carrying cost or lower principal, taxes, insurance, and interest, right? And so if those smaller homes, suddenly there were fewer of them anyways and more people wanted them, we saw those smaller, more modest sized homes or modest values still continue to increase in value. And the strain, I suppose, was on the houses that were more luxurious or affluent or bigger or just a little bit larger than what they wanted to carry. So had the average and the median come down in 2015, 2016, I would have personally been concerned. But what we saw was just a reckoning, if you will, of the average, and still that median kept increasing. And that's essentially what I'm expecting this go round, right? I think there's going to be some volatility in certain price points. I think there's going to be maybe a little bit longer horizons for people to make their decisions, but this market will not come to a grinding halt. The other thing, there's a lot of parallels that are being drawn between 2008 and today with respect to what the government's doing. A lot of it mirrors what the government did in 2008 for what they're doing today. But the thing that I want to point out with respect to real estate is that there are two very different issues. We are not in 2008 with respect to real estate. And to put some language to that, the crash of 2008 was so cataclysmic in a lot of senses because the bad bet was on the American dream. And what I mean by that is that the cost of borrowing and the access to credit lines was so free and open that people were able to opt into certain debt loads to buy houses that they potentially couldn't afford. So these loans and these rates were all structured so that you could state what kind of income you made. You could get yourself an adjustable rate mortgage. You could get yourself into a home. And as soon as those interest rates went up, so did your payment. And you would agree to that. And unfortunately, people couldn't keep up with their payments at the rate at which interest rates were going up, right? Their incomes didn't change that quickly as the debt was changing, right? So what we saw on a micro level is that a lot of people were filing for foreclosure, or they were going into foreclosure, or they were having to sell their houses at losses. Well, you compound that one case and you apply it towards the general public, and that's where the trickle down really started with real estate values going south. Now, this whole problem was compounded by the fact that we saw in the financial markets, there were financial instruments that were being invented where subprime mortgages or essentially higher risk debt were being packaged up into these packages that were being sold at lump sum values to investors who would then turn around and sell it again. So we saw these bad debts essentially being sold on the secondary, tertiary markets over and over and over again. And at the time when they were being purchased, they weren't bad debt because people had defaulted. As soon as the debt started to default, those investments that had put tons of paper value up over and over and over again were suddenly worth nothing. And that's where that house of cards collapsed, or that, if you've seen the movie The Big Short, that's essentially what it was about. So 2008 is different from today in that the underlying issue that caused the market to collapse in 2008 was real estate. Real estate is not the problem right now. Real estate is not the reason that the market is correcting. And so I want you to walk with confidence that in Houston especially, we have seen very stable increases in value since the oil bust. We found the bottom of the oil bust in 2016. We have seen on average very stable 3% increases on the average price and on the median price in real estate every single year. And so we're not in an overblown situation. The cost of borrowing is still very reasonable. And so if you have questions and you want to chat with me about it, please call me. If you had plans to do something in 2020, I want to encourage you to walk with optimism. Continue to do what you're going to do. Things are going to change and we don't know what exactly that'll look like in the short term, but I don't want to be an alarmist and I don't want you to have bad information. So if you want to give me a shout and you want to chat, please do. I've got my phone sitting right here and I'm excited to talk to y'all. It will be okay. Everything's fine. Give me a call if you want to chat. Talk to you soon.